Hi, everyone. It's Tammy Medigovich, broker owner of Casa Realty. And today I am coming to you with Mallory Reese, financial advisor at Edward Jones. And we're going to be talking about the stock market, investments, and how to save for the future. So Mallory, why don't you start by, I've already introduced you, but just give us a little bit of your background.
Sure. Yeah. Thanks, Tammy. Thank you for having me today. As Tammy mentioned, my name is Mallory Reese. I'm a financial advisor with Edward Jones Investments. Started with Edward Jones actually May 2008, back in Colorado, where I'm originally from. Fast forward to today, I'm an advisor here in Gilbert, Arizona. A mom to a 1.5-year-old and a wife, and a financial advisor, again, like I mentioned, with Edward Jones.
A very, very cute 1.5-year-old, by the way.
Thank you. Thank you. I'm biased. Happen to think so myself, but.
So you got started in this when the market was not very pretty in 2008.
Yes.
How
So
does
we find ourselves again in that?
Oh, yeah. Well, I was just going to say, how does this market compare to that market for you?
Yeah, so at that point in time, I was very early in my career, so it feels a little different in regards to where my focus is. Of course, now I have clients that are really needing to have questions answered and coming to me at this time, and so I'm happy to be there for them. It is different in the fact of what has caused it and kind of how quick things are happening. '08 was definitely more elongated, whereas, right now everything is very abrupt, very fast. And so that I would say is kind of some of the big difference. Not only, again, how fast it's happening, but the cause, like I mentioned, that was a little more focused on business need or something that was created by society, by us. Whereas this is something that's a little bit more unprecedented, as you mentioned.
Sure. So the real estate market was very strong in the beginning of the year, and we're still chugging along. We're still doing really well. We're not having as much of an impact. What happened in the stock market? Things went a little bit haywire with interest rates, and how did that impact it? People were afraid to look at their 401ks, things like that. What are you seeing? Where are we at now? What's the impact? Are we over it? Talk a little bit about that.
Sure. Yeah. So like you said, we started the year strong as well. January and February were good until about mid-February, and that's when talks of coronavirus really started and did start impacting the market. So from the peak February 19th to the trough of the market, which was March 23rd, the S&P had declined about 34%. So that is an official bear market. You enter a bear market territory at 20%, and we did go past the 30% mark at 34%. Something interesting, again, that was very, very quick to go down in, I believe it was 23 days, 34%.
Yeah.
We have actually now seen a pretty good rebound. So since March 23rd till now, we've actually been up about 26%, or actually that was the end of April, about 26% back up.
Nice.
So April has been one of the strongest performing months since 1987. And in fact, we've had some really large days. March 24th, the day following the bottom, happened to be one of the biggest days in the history for an incline in the market. So what's really been happening, obviously, the unprecedented or the uncertainty with this has caused the extreme down, and we've had a lot of volatility, both on the up and the downside. We're not back to our top just yet, but we have seen a nice little rebound in the month of April.
So is now a good time to buy? Should we be?
Yeah, good question. So it is a little tricky to answer because it depends on each and everyone's scenario. And the way I do all of my advising is always tailored to each person. And that's really going to come down to, are you relying on the funds? What's your time frame for it? What's your goal? That sort of thing. Generically, we could say, yes, it is a pretty good time to buy because we are still down. But again, it's going to depend a little bit more on your scenario and where you're looking.
That's very similar to how I answer the question when people say, is now a good time to buy? I think a lot of, or sell even, depending on the market, it depends on what your personal goals are and where you're at and what you're trying to achieve, which can, have a big impact.
Absolutely.
Should we be looking at making adjustments to our investment strategies right now because of everything that's going on?
Yeah, so I'm really glad you asked that question. This is going to seem opposite, so let me kind of expand on the answer here, but the answer is no. You should not be changing, but here's why. You want to be setting up your strategy when you first start working on your retirement plan or whatever your savings plan is, to where you know what you're going to do in the down market before you get there. So your strategy should already be drawn out before this time period. And the reason why is emotions and investing don't go together. And there's actually a bunch of stats out there of increased media attention during times like this. The more media we take in, the more negative information, the more fearful and emotional we get, and we don't make great decisions. And so if you're making decisions emotionally during a down market, you're thinking more on the short term rather than the long term, and you could derail your long-term plan for a short-term scenario. And so, no, you should not be changing your strategy. However, you may be changing your balance. You may be changing your contribution rate. You may be changing what you're in. So there's a lot of changes that could occur. It's just not your overall strategy.
So the burning question, since we're on the Zoom platform, are all the people who invested in Zoom going to be millionaires at the end of this?
Probably not. Some have already really paid off for that. Very fun, interesting fact. There was a lot of confusion with that as well. There is 2 Zooms to invest into. So if you didn't know that, yes, there's ZM and ZOOM. So you can go look both of those up and how they've fared.
Okay.
But a lot actually invested into the incorrect one, I will tell you that. But they both did well. So sometimes even luck worked out on that one. But yeah, there is 2.
So are there particular, and this is a hard one to answer, I'm sure, but are there any particular markets right now that are better to invest in than others, or ones that might be better to get out of if you're in them right now?
That does, again, go back a little bit to your scenario, what your comfort is with risk, that sort of thing. This has been fairly widespread. Pretty much every sector has been hit by that. And so when I'm talking about sectors specifically with stock market and the equity market, that's going to be diversifying between what's technology, what's healthcare, what's consumer staples, that sort of thing. What has done the best is technology, which is definitely not a surprise. We've all relied on technology as we've been working from home or trying to connect through Zoom like you're talking about.
Right.
2 of the hardest hit areas are energy and financials. Again, not quite so much of a surprise there with what's been happening with oil right now. What's good opportunities, not necessarily just what's down the most, because they may have the biggest hurdles to overcome as well. So I've been asked a lot about energy right now. I've been asked a lot about airlines, cruise lines, those types of things. There may be opportunities in there, but they're also potentially going to carry some more risk. And so again, it depends on kind of what your comfort level is, what your time frame is, and what your ultimate goals are.
Sure. Okay.
There is definitely a lot of opportunity though, because again, it's been pretty widespread. Almost every sector has been touched by it.
So as we start to wrap up, and this is more hits home for me as I have a senior graduating from high school, but there's also a lot of seniors graduating from college. They're going to be starting new jobs. My senior just turned 18, and we, from the time that he started working, set him up on a plan where he contributed a certain amount of every paycheck into a savings account. But now that he's 18, we want to take that a step further and look at things like IRA, and it's really important for us to show him how his money can grow if he starts investing at a young age versus trying to catch up when you're in those what you might consider your true earning years, right? Which a lot of people don't hit until they're in their 40s.
Right.
So even though it can hurt a little bit when you're putting X amount away, but can you show or talk to us about that and how our youth can use this time to grow their money so that when they get to a certain age, they've got that nice nest egg waiting for them?
Sure, absolutely. And this topic just warms my heart so much because I love to see people get interested in saving early, because time is one of the biggest benefits you can have. If you put time on your side, it's going to make a big difference. I'll speak at schools to senior classes, to other classes, because I want our young generation to know how important it is to not rack up debt, but instead save for yourself.
Right.
Put the compounding on the right side, on your side, not on the bank side or whoever you're getting loans from. So I think it's so important to start early. In fact, my youngest investor was at 14 into an IRA.
Really?
Yeah.
Oh, I didn't know you could go that young. We would have
You can
started
start
right away. I feel like, so he's missed out years now.
He's definitely not too far behind though. So yes, the thing that you have to have is you have to have earned income. So if you have somebody who is pre-18 and not working, then you can't really start there. But anywhere
Okay.
where there's earned income, you can start. If it's under 18, then the parent does have to sign off. It's a custodial retirement account until they become 18.
Okay.
But 18 and beyond, again, as long as you have earned income, then you can go ahead and contribute. And it's again, like I was saying, so impactful to start early. So if you could actually do the screen share, Tammy, we'll kind of show some numbers here of what difference starting early can really make.
Here we go. Can you see that?
I can, yes. My screen is really small, so hopefully I can direct you right. But if you could change it to where we're starting with $500 a month of a contribution.
Okay, we have that.
Do we? Okay, great. And then 30 years is the time frame. Is that right?
Yes. And so when I do the results, if you can't see that, let me see if I can make it a little bit bigger too. But
yeah, if you could make that bigger, that's where the rubber meets the road right there. Okay, wonderful. Right there is good. So what you'll see in this scenario, the total principal, which is the third one down, you'll see that over those 30 years, about $180,000 was your own money that went in.
Okay.
That $180,000 became over that time of a reasonable return of 7%, $588,000. And if you look down at those three lines, if you could scroll just a hair, Tammy, the green line down there is the total return of what you've put in plus what you've earned. That blue line that's below it that also curves is just the interest.
Okay.
So you'll see how much it curves in those later years. Sometimes for your first 5 years, it may not feel like a lot of traction is happening, maybe even your first 10 years. But you can see how that time really starts to curve more in those later years. And that's where you really start earning a lot more interest above and beyond the principal that you've put in.
And that was a monthly 500. Okay.
Monthly 500. Yep. So now let's go to scenario 2. So if everyone will remember, you contributed 180,000 over 30 years.
Okay.
So now let's change it, Tammy, to monthly 1,000.
Okay.
And the time frame to 15 years.
And we'll calculate that.
Yep. So first, let's go into that results section. If we could zoom in there really fast. Again, yeah, you keyed in on the right spot. So the total principal is the exact same dollar amount. It's 180,000. You put in the same money on your end. But because we have less time, the end balance is now 312,000. So that is a difference of $275,000 just because you started later. Yep, exact same amount that got put in, but it's the later. So now if we go to these three lines, which again, I just love this right here. Again, the green is what you've returned, everything together. But now look where the dark blue line went. It went below your principal.
Oh, this one here.
That one there, yep.
Okay.
See how it never actually surpassed your principal? And remember how that other one did?
Yeah.
That it means that bottom line means you're still earning money. That's the portion that you're earning. But on the previous one, you had earned so much it surpassed what you made, or what you put in. And so that time just really, really makes a difference.
Okay.
And for this scenario, we started with 500 as just an example per month. I always tell our young investors, I really don't care what amount you start with. I just care that you start and that you're consistent with it. So maybe you start with $50 a month, and then maybe make it your goal that every 6 months or a year, you increase it by $50.
Yeah.
You know, if you do it in that way, it won't take you that many years. You'll get to 500. And what's important about that, if it's built into your budget early on and you stick with it, it'll never feel like you're having to really make big changes in your lifestyle to do it because you're just so used to it. And you had mentioned, you know, about your earning and how you earn more later, and that's when you feel like you got to start.
Right.
It's interesting, though, that with the way life goes, a lot of times your debts go up later. Maybe the home purchase does come in as we talked about, but then also kids come into play, things like that, that people sometimes feel tighter to contribute in that mid-range than they do in their early years.
I feel like too, if you can get into that habit of it just becomes a part of your budget, you know, this is how much, and if it just goes straight away from your paycheck, then you're not worrying about it, you know?
Yeah.
Now, in the case of my son, where his earnings, he's not earned enough to necessarily file a tax return, so there wouldn't necessarily be a tax benefit, or would there, or what, are there any strategies there, whether you're young or old, with regard to putting money away in tax strategies?
Sure, absolutely. And actually, I'll answer this in a couple parts. There's a lot of tax strategy even to do right now when the market is down when it comes to your investments. Because there's two different types of retirement accounts, whether it be at work or as an individual that you can invest to. And it's either called a pre-tax or a traditional, and the other is going to be called a Roth. So a pre-tax or traditional, you get your tax benefits today, but you go forward and pay your taxes in retirement. So it's called tax deferred. You're deferring those taxes until later because you got your benefit today. Now, a Roth is the flip of that. You do not get tax benefits today. However, everything that it grows to in your future is tax-free. It really depends, again, on everyone's scenario on do you need your tax benefits now or in the future. But I will say kind of a tip for young investors, that's a lot of years to grow. That
Sure.
Roth might be the right way to go because you said it, they're in low tax brackets now, but all that growth becomes tax-free if you go that route. I am not an accountant or a CPA, so I recommend to get them involved. However, Roth can be very good for young investors.
Well, and especially if you're earning and still either living at home or you have a lot of your expenses already being covered, just ignore that money and put it away. So
it's great. It's huge. Yeah, absolutely. And then if I could share just a little bit more too in regards to the tax strategy right now with the market being down. Again, talk to an accountant if you work with one. I'd be happy to answer questions or a financial advisor. But there are also strategies right now that are called conversions, where let's say you have a lot in a pre-tax account, but maybe it's going to be a lower tax year for you. You were unfortunately laid off with what's happening. Maybe you're in a sales position and there's just not as much happening right now. If you wanted to move some from a pre-tax to an after-tax, you can do that through what's called a conversion. If you do that in a year that it's low tax for yourself, tax brackets right now are low, market's low, you pay less taxes. If you're moving a lower dollar amount, putting it in a tax-free place to where, again, the growth is tax-free.
Okay.
Again, I never recommend this without trying to get a little bit of insight from somebody's accountant or CPA because we want to make sure we're not adding more unreasonable taxes. But it's definitely a strategy I've done with a lot of my clients this year is to convert some of the funds for them.
Excellent. Now, last question, pull out your crystal ball. All right.
Okay. Yes.
This is the one I ask to do all the time. Pull out my crystal ball and tell me, what's the rest of the year going to look like? Are there any forecasts or speculation based on, what we are going through right now and how we're going to come out of this? And like I was mentioning, the real estate market, as going into COVID was very strong, and we very much expect us to come out of it very strong and to rebound simply because interest rates are low and the housing demand is high. And so that's not going to go away. It's just shifting our season. How do you experience the same thing? What do you expect for the rest of the year, given everything that we're going through?
Yeah, so a lot of analysts have really estimated that there will be a V-shaped recovery. So it happened quick. Our rebound could be quick.
Okay.
I started to hear more U-shaped recovery. So maybe kind of not as quickly comes back up, but we still have some positive for the future. Right now, and maybe one thing I should throw into, we are in a recession. A recession, if you do not know, is 2 quarters consecutively with declined economic activity. Okay. So first quarter was a decline from January through April, down about 4.8%. May through whatever that would be, June, July, August, we're estimating, of course, will be down as well. And so these 2 quarters of recession will probably still be a little volatile, a little rocky. But if we continue to get positive news of the fiscal stimulus is working, getting people back to work is working, the optimism is what can lead that market to going back up. Okay. A lot of times individuals will think that if you look out, there's still a lot of cases or there's still people not necessarily back to work just yet. That's not always the defining factor of that stuff has to go away before the market will come back. The optimism could lead the market up before that stuff happens. So for example, April, we were completely shut down. Yeah. There was a lot of unemployment, unfortunately, but the market still rose a lot. So we may see kind of a U-shape or a V-shape. I do think we're still going to see some volatility just because there is a lot of headlines still. So you're still going to have some big volatile times, I would assume, but I have optimism that we are going to ride out of this. I don't know by the end of the year, but I think we'll do pretty well with it.
Okay. So no need to panic. Just get in touch with your expert the same way that we talk about in the real estate. No need to panic. It just depends on your situation. Depends on when you're, it's, you haven't lost anything unless you've pulled it out, right? So
absolutely,
if you're just letting it ride, if you have the time for that, and if you're just starting to invest, it's certainly a good time. And if you're at the end of your investment, well, then that's when you really lean in. I think at any point, lean into someone like yourself who can help guide depending on your situation. So
sure,
excellent.
Absolutely. I say all the time, periods like this are not fun to look at your statement and see that number, but they're normal. Maybe not to a degree of 34% necessarily, but volatility and pullbacks in the market are normal. And so what's really important is what you do during those times. Yeah. The better decisions you make during those times, the better long-term returns that you have. So try to look at them as opportunities. If you are nearing retirement, as you had just mentioned, yeah, that's a very different factor than getting started. But again, you should have a strategy in place already, because retirements are long these days. You're not going to go through a full retirement without a pullback in the market. Yeah. So it's not running away from that volatility. It's understanding what portion of your portfolio you're going to get your income from while the market is down, and letting the rest of your portfolio rebound.
Gotcha. Well, and one of the things that I really appreciated too, and I think for me, this speaks volumes to where I will send my business after all this is done, is your office was one of the first ones that called us to say, how are you doing? How are you feeling? Yes. No panicking, because everybody was kind of whirling. So that's always appreciated. And I thank you for taking the time to answer some of these questions. Do you have any closing information that you want to give us, or have we covered everything? Any last bits of advice?
Yeah, we really covered it. And like I said, thank you for taking the time to have me on here. You're absolutely right. I have been here since the day this happened and making sure I'm answering questions, hopefully being proactive to reach out to everyone. And I think that's the key right now, is stay educated, not necessarily media educated, but generically educated on the topic. And I'm happy to answer any questions if anybody does have them, to just make sure we keep the fear out of your choices when it comes to your investments.
Excellent. Well, we'll make sure to put all your contact information at the end of this video. And thank you so much, Mallory. We appreciate it.
Thank you, Tammy. Yeah.
All right. Bye.
Bye, everybody.